Constructing your all-weather self-managed portfolio. All-weather, again, is a buzzword, but again, it just means it should be something which helps you grow your money during normal time and helps you also protect your money when there's a crisis, when the markets are in turmoil. And I'm just using that as a visionary association, my little fishbowl here, where again the bowl is kind of talking about portfolio purpose, size, duration, what is the money you're actually trying to save and make grow. Where the fish are your assets, what kind of properties should they have, and then talking about the water, which again means more the method you're using. Is it tactical? Is it a buy and hold? Is it fundamental? These three elements. Going a little bit more into the bowl. Fundamental question whenever you start with your setting up a new portfolio is, what's the purpose of it? Is it for your retirement? Is it something you're setting up in the age of 20, where you do your first money and then look for ways how to invest it? Is it something you're putting money aside for your kids to pay college later? Is it something, the first $500,000 when you're mid-career, doing the first serious money? Or is it something which you, when you already are in retirement and need an income from your investment to basically cater for your spends? As you have seen, the four of us, we are a little bit more in the third, fourth category, but some of the strategies we're offering also suitable for younger, more aggressive investors. It really depends on how you blend your portfolio together. Some of the things we also see is we do not expect any time in the next 5 to 10 years to see 5 to 6% risk-free return as we had 10 or 15 years ago. We just think this time is over. In today's globalized world where we have a lot of currency wars, everybody's trying to devaluate the countries, the currencies, where a lot of the leverage has been moved from the private sector now back into the public sector. The sovereign debt really now is the problem in the world, and we don't see how this would change, and where there would be an interest environment again of even 4%, 5%. Another thing which we expect and what we design our own strategies for is not rising interest, but rather rising in volatility. We do expect a lot more bumps on the road. The last 6 years have been just incredible. This is a lifetime opportunity. I hope everybody was fully invested. I was not, and I still think I should have done better. The next years will be clearly much more bumpy with a lot of macro events, crisis. You see a lot of also countries in crisis right now, whole Middle East. So that there's a lot of risk and potential for small explosions around the world. There's a lot of the world or the financial markets are much more driven by central bank events, and we also expect that to continue in the near future. So we set ourselves up for rising volatility and not really rising interest rates. Another thing which we will also have, I will have another different slide, is the time for simple buy and hold, simple off-the-shelf asset allocation, as many financial investors are still offering, is just over. Today, everything is correlated. As you've seen in the last 08 or 09 crisis, if equities go south, everything else also goes south. So how do you protect yourself with buy and hold? This mechanism of low correlated assets in the traditional sense is just not working anymore. And another thing, we also expect that in future, the cost of living in retirement will further increase. One coming from everybody of us hopefully will live longer, plus the annual expense you have also will increase. One of the biggest driver is healthcare, which I know the discussion in the US, but I think it's also true outside of the US. And some of the traps which come with that also is complexity, cost, discipline. Yes, I think, or we think, everybody needs to dive deeper into managing their own money. It's just not buying a fixed solution and applying it. You need to invest more time in it, but this also means a higher complexity. More education, more study, more weekends, more computer. It's a quant word. Yeah, and one has to be set up for that and willing to do that. This should not happen. And this is why study, challenge, study, rinse and repeat. Take care of your costs. I'm managing my own money, not because I'm too lazy, it's just I'm too greedy. I don't want to pay a bank 1 or 2%. I rather keep it for myself. And the other thing, which again is normal wisdom, nothing new, if you do self-managed investment, it requires a hell of discipline, a lot of anti-stress and sleeping habits, especially if things go south, that you don't pull the trigger and get stopped out when it's just the worst moments. Then let's come to the funny fish. Asset selection. Again, cross assets, diversification still is important. Assets are more correlated, especially in crisis moments, but still low correlation and diversification is a good instrument for crash protection and also for hedging, depending on the needs you have. Be careful with backtesting. Whatever backtest you show me, I can replicate it, make it nicer, and show you 100% return. Yeah, I just have to plug Apple and Tesla in there, or other things. Yeah, 90% of these backtests you see are fakes, which obviously does not include ours. No, it's really, I mean, if you have worked with backtesting, you can do miracles if you want to have them look fancy and nice. And you cannot just detect it by looking at the charts. You need to really understand what assets are in there, how the mechanism works, what Al was telling. You need to understand rationally what's behind there, how that thing is working. One thing we use, and this goes a little bit, I just mentioned that Gary Antonacci, dual momentum, we use this kind of blocks. Take a bond, pair it with an equity, and you have a nice pair switching block, which you can use then with another block, using Antonacci again, real estate with a bond, and these things pair each other, and then you can block them together. So these kind of building blocks, and I'll show you a chart with that later. You just have to ensure these building blocks have something which drives performance, typically equity, plus something which is low correlated, which works as diversifier. And then these little pairs, you can actually treat them as if they were an asset by themselves. Yeah, and then build on that your strategy. What we use is only passive investing. We invest 100% in ETF. Personally, we do not use mutual fund, mostly because of cost, availability, fixed holding periods, and other things. If you are in 401k or IRA, you might have to replace ETF by mutual fund, which is fine, but just from our preference, ETF goes over mutual fund. Sometimes for hedging purposes we go into futures, we go into options. We have a lot of, let's call it our hardcore community. They ask us, hey, is there any way we can go use options and futures? And then we tell them that normally our strategies are 100% ETF. Which means also, as long as you're not hardcore community, stay out of that stuff. Yeah, don't play around with futures and options. I've burned my hands too many times by myself, thinking I was clever enough, and I'm not. So don't do that. And especially futures, if you don't understand them, this is really ugly stuff. Passive approach I already mentioned. Again, there is no market you cannot replicate with an ETF today. With all that stuff, the 1500s you have available here in the US, really no need. There are some very special niche markets, small cap, Indonesia, maybe you find a mutual fund, an actively managed fund which is performing better because there's an excellent stock picker, but normally passive investment is just the easier and better way to go.
I understand ETFs have an advantage over mutual funds for the actual investor.
Yeah.
But ETFs have only 10 years of history. So mutual funds have a big advantage for understanding and validating.
Yes. Yes. No, definitely. And again, especially for the individual investor, whenever you try to do backtesting, the short time period of data you have available is a problem. So also when backtesting, for example, sometimes we swap or try out with mutual funds just because you can get the data back from the 80s. But then again, once you have validated whatever you want to do, using mutual funds, then again, swap them back, and for the investing, use ETFs.
If you're looking at ETFs that are basically exchange-traded funds that pair an index like the mutual fund, I mean, you just basically find the correlated mutual fund relative to the ETF from an index standpoint, and I mean, you should be able to do that. Now, the actively managed funds, et cetera, then you got a problem.
And this is what I mean. For example, there are excellent mutual funds like Vanguard, for example. They have a couple of passive mutual funds which are really tracking an index with extreme low expense ratio also. These are quasi-ETF. Yeah, but still sometimes they have fixed holding periods or other secondary effects you just have to check. Yeah. But you're right, I was more on the active managed mutual fund side, which have typically expense rates of 1% or up to 2%, and you just don't know what's in there. Again, when working with ETF, still there, first of all, go by the most liquid ones, check the expense ratio, check the tracking error, which today is less of an issue anymore. When selecting your broker, just go with the cheapest. Today it's not a selection of quality, it's really a selection of price. Ourselves, we do interactive brokers, which I think I can mention here just because of the cost side. 100 shares, 0.5 cents. It's just incredible today. Sorry.
On liquidity, do you have a minimum volume, daily volume amount?
Yeah, I mentioned here 60K shares per day. But again, this is just depends on the money you want to invest. Yeah.
With 60,000 shares a day, and then you have all the subscribers, at some point, it's going to be, you're going to run into major slippage issues in following your strategies.
That's one of the questions which comes up sometimes. see, actually, even if we would have 200,000 followers, yeah, we would not make the market. Yeah, with these volumes, even in very exotic ETFs we would use, and we go into some volatility ETF later, we would not determine the market. So I don't think we would actually increase the spread or make the market in that sense. And if you look at the more broader ETF we have in most of our strategies, SPY, S&P 500, TLT, I mean, those are liquidity of 6 billion asset under management. There's absolutely no risk. Valid question, but really I don't think so. Yeah.
But it's a function of the account size.
Right, and we do have some private investors. One person, for example, who's really investing with 10 or 20 million into our strategies. And there we also told, don't go into ETF with that account size. There, for example, it's more appropriate to use futures, yeah, because also you don't have an issue with the multiples. Future contract is $150,000. But again, for the normal humans like us, speaking for myself at least, we're not going to make the market in that sense and increase the spread. And again, trade yourself. If you get a little bit used to executing at your broker, Fidelity, Schwab, whatever you have, if you use monthly ETF rotation strategies, after a couple of months, it just takes you 15 minutes. Yeah, you can do it Sunday afternoon or Monday morning at the open with the tools you have. So there's no need to spend money for, again, I'm talking about saving you some money for your financial advisors or trusts or whatever it is to do the execution for you.
Any plans to automate your trading signals using the in-app broker's API?
Again, we are doing it by ourselves already because of laziness and because of keeping our hands off our own investment. We are not so high sophisticated as a platform, again, that we would offer that right now. We would rather than offer a fund, for example, designed for low cost, or an ETF, where then people could invest in our strategies. Yeah. So again, I like the IB API things. We're using it for ourselves, but making it available for the broad public is just it's a different dimension we are not offering right now. And last slide on our fish here, the water. And again here my little slogan, communism, Elvis might still be alive, buy and hold is that, definitely. If you invest today, yeah, you might run into one of these nasty little minute crashes, which we have seen and which are getting more and more. Whenever something happens, the algos, which are out there and driving more than 80% of the volume in many of the exchanges, they react in nanoseconds and microseconds or even seconds, and we humans react in minutes, hours, or days. So these little beasts, they will always be smarter, clever, and faster than us. Whenever this world will go bust, the algos will drive the equities down to zero, not the humans. Yeah. If you use buy and hold, yeah, and something happens out there in the market, yeah, you will just get sucked into this quick. And again, I'm not saying the gold world will go bust, but if it would, then we don't have the reaction time to take care of our buy and hold investment. So whenever you invest, you need to have a market mechanism in place which protects you from that correction, and you cannot trust in your broker or in yourself to take care of that.
In the last few years, I have been whipsawed in and out, from something like from high frequency trading, and it seems to me that and it's because I had, stop losses and things, that if I had been in buy and hold, it wouldn't have affected it because it went like that. So what's the better solution other than buy and hold?
We come to that, and again, it's no universal wisdom, it's just the way we think it might work best. And you're just making the example. Also another question which hopefully will come up, keep your hands away also from stop loss limits. Yeah, these just kill you. Yeah, in the market crash 2010, May 2010, stocks went down 30% within seconds. There you get stopped out, and then with another 5 seconds, market come back 30%. Yeah, and again, this is individual stocks, and in broad ETF it might be less, but these things are really killing you and not protecting you, because again, these algos, yeah, they drive, depending on the exchange, 60–80% of the volume.
The algos, isn't it going to be increasing logarithmically? Can we really do anything about that, even the buy and hold? Because their function is to increase volatility, because that's how they make their spreads.
I don't want to dive too much into this discussion, but there are very nice charts which I don't have with me, how the percent of automated traded in the stock exchange has exponentially grown in the last couple of years, starting 2000, but then exponentially after the crisis. Yeah, there's a nice website called Nanex. If you don't know, like it's spelled, nanex.com. They have these very fancy charts to show you how these algos actually work and what damage they also do sometimes.
Could you kindly spell the name of that website?
Nanex, Nanex.com. I can send it later, or send you some charts also what I mean.
N.
Nancy. Nanex. Another thing is, the trend is your friend, but also volatility is your friend. At least a certain level of volatility. For example, the last 2 or 3 years, yeah, this market was just too complacent. Yeah, you had volatility levels incredibly down to 3 or 4%. Yeah, and the only thing going up was equities. SPY taking one record after the other. Yeah, that's just not natural, in my definition at least. It's nice if you're 100% invested in SPY, which hopefully you're not, because again, this can also then kill you. From our point of view, you need what we call a natural level of volatility, which again for the SPY for me is in the range of 12 to 15, 16, up to 20%. And if you have that volatility in equities, in all different asset classes, then kind of in my visual terms, the money is just swapping naturally around. Yeah, and then the correlation between the assets can just take place, and this is the best time for our quant strategies. If there's no volatility and our dear Mrs. Yellen speaks up every couple of days and then the market just go nuts, it's not good for our strategies at least. Risk on choppy markets are bad. This is exactly what I meant. Central bank driven events, macro events, wars, these things are bad for quant strategies. And we have seen that 2012, 13, 14. Yeah, whenever these periods are, these trend following strategies just don't perform. So, just a chart to show you what our approach is for building up your portfolio. And I'm trying to show you that in a visual way. It's like building Lego blocks. The first level is your assets. Bonds, emerging market equities, US equities, international equities. You might add China. China is an asset class by itself now. Sectors, commodities, classical stuff. On top of that, asset classes which you can use as diversifier for crash protection, or in case you're non-US dollar based, also for hedging currency, for example. The next level, the water, your tactical approach. Yeah, a couple of the algorithms we use, the tactical approaches can be classical momentum driven. We use something which we call our modified maximum Sharpe algorithm, which just can ask a copy to Al. He has perfectly cloned that already. We also work with volatility control. Again, certain volatility is needed. If it goes above a certain level, it's bad performance. You rather scale down your exposure. You stay a little bit out of the market. Only invest 60% of your asset. If volatility comes down, you go up back to 100%. You can leverage. We do employ leverage in some of our strategies, optionally, yeah, up to 200%, which makes sense, again, if the volatility is too low. Yeah, and you have a very robust strategy, then you just leverage, and you can leverage using margin account, you can use leveraged ETFs. We're going to show you a couple of strategies which do that. And another proven mechanism is mean reversion, which we are not employing right now, only in one strategy actively. Was the question?
These are ETFs that you invest in?
No. These first two levels, those are available as ETF. Yeah. The next level here, this is then let's say the algorithm or the method you use for investing in ETFs. Yeah, there are ETF available, for example, in that sector here. You can buy the famous Smart Better, which is getting very popular recently. This is minimum volatility, basically. Yeah, there are pre-packaged ETF solutions available, but again, we just say we do it by ourselves. Let me add it, and maybe it comes clearer if you see the full picture. And again, if you add these three first levels together, then you basically end up, I'm showing here these strategies we have in place, but again, you can custom design your own. But this is then what we call in our language a strategy. Having a strategy, and again, see these as little boxes you can add together. Yeah, you have a strategy which is mostly bond. You have a strategy which is mostly equity. Yeah, add these together into a portfolio. Yeah, and then you have a classical asset allocation, but not based on individual assets, but on building blocks of assets.
Just a question. Your bond rotation strategy, you got sleep well in quotations. Well, if you're invested in bonds and interest rates are volatile or going up, to me, that's not sleep well, because you can lose your tail in a bond strategy just as you can in an equity strategy, because when interest rates go nuts, your bonds get devalued.
I show you how the bond rotation, or why we came up with that fancy name of sleep well.
Okay.
It is it has an implied crash protection inside, so it's very smooth, and this is the smoothest of all our strategies. This is why we call it sleep well.
Okay.
Yeah. But again, at this level here, we would be a buy and hold if you want a fixed weight asset allocation into different strategies. Sounds complicated already here, but it's really easy at the end to implement and to have that monthly. The bug is what we call our enhanced portfolio. The bug is because of the article which was referring to this famous Volkswagen poster of "Don't kill the bug," if you remember. Yeah, it was in the 70s, 80s, I think. This is how we use that poster. So right now it's our bug. But bug as car and not as arrow. If you don't want to do that here at a fixed weight, then just rinse and repeat. You can take your different strategies and also say, okay, maybe as you just said, one strategy might not perform in a certain market environment. Something might break in the market, something just will not continue to work as it had been in the past. So why the hell would I invest 30% fixed into a certain strategy? Okay, then don't do it. Just again say, I'm always going to invest in the best 2 of those 6 strategies. Or I invest into the best 3. Or I invest into a mix of them, which gives me the smallest volatility, highest sharp, depending on what is the approach you're looking for. And then you end up with what we call a meta strategy. A maximum sharp optimization using different of these strategies. Yeah, and again, I'm tuning up the complexity a little bit, and later I show you how to do it easily by yourself. Example. Just your what you said. Take some bonds, add some treasuries, use a maximum sharp algorithm, and you end up with what we call our bond strategies. These 3 building blocks. Next example. Use treasuries, add some volatility, and this is a volatility ETF. Use again maximum sharp optimization, and you end up with what we call our maximum yield strategy. One more. Take treasuries, take US equities, ask L, and you get a perfectly coded universal investment strategy.
Question? You talk about volatility.
Yeah.
Are you talking about VXX?
I have some wonderful volatility slides for you afterwards.
Okay, because my comment would be VXX has a decay function. It just does not perform well.
No, we use the opposite. We use inverse, which is called CIF.
Okay, I'll wait for your
CIV. And because you asked about the bug again is permanent portfolio, which is quite complex if you look into how it works. And it uses pretty much all of that. Bonds, EM equities, US equities, international equities, commodities, treasuries, volatility. It uses mean reversion elements. It uses leverage in one option at least. And this is one of our strategies.
What would be your percentage asset mix for these kind of building blocks?
I come to that also in a minute. Mix those 4 together, and again here I'm just example 30% bonds, 20% maximum yield. Oops, that was too fast. And you would end up with again a fixed weight portfolio. If you say, but maybe rising interest rates, what happens with the bonds? Okay, then don't do a fixed weight. Use these strategies again and apply, for example, momentum. I always invest in the best 2 of these strategies and ignore the other ones. I invest 60% into the best, I invest 40% in the next best performing. Once the bond market is not performing anymore, bonds simply will be ignored. Yeah, and again, it's just a strategy of strategies if you want to have. And we just call it meta strategy. It's again just another fancy name.
Question. I'm looking at that where you've got the fixed rate portfolio. It doesn't add up to 100. 30 and 30 is 60 plus 40 is 100 and 30 is 130.
Because I applied leverage in that example.
Oh, okay.
Yeah. Or because it was an error when doing the slides. Don't ask me.
I was just wondering whether this was new math.
Will you be covering how you decide what the ranking, relative ranking,
Yes.
the process?
I show you this is the Markowitz meets logical invest part. So again, these were just the building blocks as we see them when constructing the strategy. It's a conceptual picture, yeah, just to show you which blocks from our perspective are there and how you can play with them when building up your portfolio.